Hello all Inderes TV listeners and viewers. I'm here at Fabian Katu, Sampo's headquarters, and I interview Sampo's CFO, Knut Arne. Knut, congratulations for another great result.
Thank you very much.
Would you give us some highlights about the last quarter of 2021?
Be delighted. The fourth quarter of Sampo followed a full year of excellent quarters and consequently a full year result. We improved our profit before tax by around 650 million euros for the full year, excluding extraordinary items, which basically means accounting effects coming from our sale of Nordea shares. We improved our underwriting profitability by 32%, which does include the fact that we now have more P&C insurance business in the group, Hastings, which we bought late last year. And of course, some COVID effects, which is lower than in 21, also in the fourth quarter compared to the same period last year. Adjusting for these elements, we still grew our underwriting profitability by close to 20% for 21. Also supporting the result is excellent financial markets, which have made our investment returns really good for 21 as a whole.
You started executing the new strategy around 1 year ago when you had a Capital Markets Day. I think it was back in February 21. So how happy are you with your performance thinking about this new strategy?
I think with the results we delivered in the fourth quarter and since our Capital Markets Day, it's quite obvious that to have a strategy that focuses on P&C insurance operation with the excellent performance we do have across all the P&C insurance businesses in Sampo is the right strategy. We have a good momentum going into 22. We have delivered on our financial targets. We have reiterated our financial targets with comfort also going into 22. So really happy about what we have done and what we have delivered and showed to the market in terms of our P&C operations since the CMD last February.
Now investors are very concerned about inflation and of course about the possibility that the rates will go up even here in Europe. We talk about this in previous interviews as well, but the subject is of course on the surface all the time. How would inflation affect your insurance operations if you would go a bit deeper in the details, pricing or etc.?
Sure. When it comes to interest rates, as such, Sampo has been positioned for increased interest rates for many, many years with really short duration on the asset side. So when interest rates rise, which they now do, let's see if it continues, we would have the possibility to reinvest at higher rates very quickly. We have duration on the Inderes portfolio, for example, of 1.2 years, which is really, really low. It's basically money market instruments. And even on the life side, we have a duration of just about 2 years. So really short duration, well positioned to take advantage of higher rates in expected fixed income returns. On the liability side, higher interest rate would mean capital generation because the so-called the capital position in life insurance business will benefit from the fact that interest rates will be closer to the guaranteed rates on the old with profit book in runoff in Mandatum Life. And also in the non-life side, the non-life reserves that are also some of them long-tailed and discounted could then benefit from being discounted at higher interest rates and consequently generate capital, but both from a solvency perspective and from a sort of shareholders' equity perspective in our IFRS balance sheet. When it comes to inflation, the most important tool to manage inflation for non-life insurance companies, of course, to have a pricing levels in our product, which represents claims inflation, which, by the way, is not always the same as CPI inflation, which we currently have across the book. Doesn't mean that we don't need to be on our toes to continue to have that also going forward and monitor claims inflation developments and take actions if needed. But as we speak here and now, we go into 22 with pricing levels and pricing adjustments, which covers the current claims inflation that we do see.
And you have the pricing power to adjust prices if you need it to be necessary.
Since we've been able to do that so far, that's quite clear. I think that the claims inflation isn't that different for the companies we also compete with. They would have similar needs to retain their profitability levels. But of course, we could see different reactions from different companies. But given the size and strength of Sampo, the pricing power, of course, is not less for us, and the possibility for us to also have more muted interest in certain products if needed, if margins are not good enough, we could also do because of the size and diversification we have in our business. But that is not the environment we have today. We have price levels which covers the claims inflation environment which we currently see.
Then there's another perspective to competition that goes like that. Because of the low interest rate environment, almost all insurance companies have focused on the combined ratio. So maybe the competition has not been so tough because your fixed income is so low. But if that becomes a tailwind again, that you get more fixed income, could that mean that in the longer run you see more competition between different insurers, and that could harm the combined ratio? Do you see that as a plausible scenario?
Let's not get carried away with the changes that have happened in interest rates up until now, and the interest rate levels where they are still extremely low.
That was a bit too great, maybe.
That correlation doesn't happen overnight. If you took a very long time scenario where interest rate were at a significant higher level, of course there could be trade-off between underwriting profit and sort of risk-free profit from fixed income portfolios, and still generate a strong ROEs, which we see. But that is not where we stand going into 2022. We still have very, very low interest rates, which means that underwriting profitability is key. And also, of course, makes us comfortable starting the year with the underwriting profitability and pricing environment that I just mentioned. But also going back to my previous answer on your previous question, if interest rate wise, we are well positioned, even better positioned than some others in terms of taking advantage of that on our fixed income portfolio because of our short duration.
There was one, of course, many interesting aspects in your report, but one was that you actually bought shares of Topdal. And if I recall correctly, you have many years, Sampo has stated that the price for Topdal shares are too high, and that's why you're not buying the shares. But now you started buying those shares. So has there been a change in your thinking? What's behind that?
I think for all investments that we do, there needs to be a viable financial business case. That's not only specific to Topdal. We were offered some blocks a few months ago, and at the prices that we could buy those blocks for, we found it to be a viable financial business case. Doesn't change. Or that we still need to see that for any investments we do going forward. And I think that has always been the case in terms of making, like this was in smaller investments, like some blocks in Topdal.
Has there been any change in the competitive landscape in Denmark?
I don't think this was a very big indication that we have a different appetite in terms of Danish non-life insurance. We've been an investor in Topdal for a long time. We obviously like the company. We believe in what they are doing in the Danish market. That also goes for our own If-based if branded Danish business. So this shouldn't be sort of viewed as a different appetite in terms of the Danish insurance market. If you look at Top's results for the full year, it's obviously an indication that also the Danish market is a good market to run non-life insurance operations for the best operators in the market, which Top is as we speak.
Then one question about Nordea. There might be a bad taste of hindsight, but how do you see the divesting of Nordea now, since it has definitely become a better bank it was a few years ago? So if we think about it now, has been a wise decision to leave Nordea just now as you have done, basically?
Really happy that Nordea is a better bank and that's reflected in an increase in share price, which of course have been very helpful for Sampo's investors because we have made more money on that investment and also got more proceeds from selling shares than what we maybe could have hoped for when we had our Capital Markets Day last February. So sort of having a non-life insurance focused strategy, which means that we have materially reduced Nordea shares and obviously have some incentives to continue to do that over the next 2 months as well, is sort of a beneficial situation for us. So then when we started that journey, we had quite a few shares to sell. So we couldn't sort of pinpoint the exact day and try that we could sell 20% of Nordea in one go. That's also why we gave ourselves those 18 months at our Capital Markets Day last February.
Then last question about capital allocation. You're showering shareholders with dividends and buybacks this year, but you still have quite much extra capital in your balance sheet. So how do you see it in the future? How fast you're going to maybe return that extra capital to shareholders, or should we look for another acquisition, or what sort of things?
We're committed to our capital management framework, which we also set at the CMD. I've been referring to a number of times here now during the interview, which means that we want to have a solvency range between 170 and 190%. And excess capital above that solvency range will either be redeployed in the business by, for example, bolt-on acquisitions, or return to shareholders. And we are committed to that capital management framework. We have no intention to build piles of capital above that solvency range. Now, as of year-end, we had a solvency ratio of 185% when deducting the 4.1 euro dividend, which you are alluding to. And that is within our capital management framework. Then, as you also think about, we do have more Nordea shares still, which again, it's beneficial for us that Nordea share price goes up because we still are the largest owner in Nordea and have close to 250 million shares. That will, when and if those shares are sold, generate excess capital, because it obviously, like it has done when we have sold other shares. We have had a history now during 21, if you can call that a history, to communicate fairly quickly on use of proceeds. But to address excess capital when we have 185% and still Nordea shares to work on, it's a little bit premature.
Just one more question about your guidance regarding I think in the previous years when you gave guidance, you have given investors a range. Let's say this is just an example, that if combined ratio should be 90 to 95% or something like that. But now the guidance was that it will be below 85. So what's the reason for this kind of guidance? Are you careful with maybe the COVID or something else?
We have a tradition to start the year with sort of one level, and then during the year adjust that level to be more of a range, like you say. That range hasn't necessarily been what we have communicated at the start of the year. Also historically, of course, we have started the year by saying that the combined ratio will be much higher than the 86 number we now use for the group, and 85, for example, or in If, and 88 in Hastings in our outlook. The outlook we gave today includes combined ratio targets, which is exactly the same as the targets we set for ourselves at the CMD in last February. And it makes sense for us at a year after to stick to the same targets. Doesn't mean that we will not adjust those targets when we, or that outlook during the year, when we have even more certainty in terms of how the year will develop. And it should absolutely be not be read that we're not going into 22 with confidence. All of these numbers in the outlook is, of course, below 86, 85, and 88 respectively for the group If and Hastings. Now, your COVID comment is also valid because our 21 result, as I started to talk about in the beginning of the interview, does include some COVID benefits, and we don't expect those COVID benefits to be repeated. So that should be thought about when comparing 21 and 22. We expect 22 to be a, I'm not sure what normal means, but at least a year with very limited benefits from restrictions that will last for the remainder of the year.
Thank you, Knut, for the interview.
Thank you very much for coming.